Welcome to Call Options for Newbies, Part 2, Volatility and Greeks. My name is John Broussard. I'm going to be giving you this presentation where we will discuss call options for traders who are just starting out trading call options. In Part 1, we went over the basic call option and the bid and ask. And in Part 2, we're going to look into volatility and what the Greeks are inside of a call option. Presentation is copyrighted, but please publish it as you wish, as long as you indicate optionsanalysis.com is the source. This presentation is not a recommendation, nor is it advice to buy or sell any stock mentioned. This is an educational video discussing call options and volatility. Your results may vary, and there is risk in trading stocks and options. There are no guarantees in any trade. All charts and analysis in this presentation were done with optionsanalysis.com. Google Options Analysis to find us. You'll land on our login page shown here. There's other free videos you can watch. You can also sign up and subscribe and start using the website. Volatility. Volatility is a statistical measure of the dispersion of returns for a given security. The higher the volatility, the riskier the security. We are looking at what are the changes in the daily difference in the stock close price. How does the stock change day to day? If you take a large number of stock changes and count values and put them in different bins. So things that didn't change much would go in the 0 bin. If it changed a point, it would go into the point bin. If it changed 1.5 points, it would go into the 1.5 point bin, or the minus 1.5 point bin, and so on and so forth. And you would count them up over many occurrences and put them on this chart. If you fit a Gaussian curve to this daily difference dispersion of stock returns, you get a decent fit. And that becomes the assumption that we're going to make about stock statistics, that the return dispersion is Gaussian. This implies that the stock itself has a log normal distribution, if you're familiar with statistics. Gaussian means that there's a high probability that the price will be somewhere, the price difference will be somewhere in the center, and a much lower probability that we will experience higher and higher price differences in other times at other periods for the given statistical volatility number that we're using. We're going to be studying two different call options. One will be the 29 strike November 16th call option we looked at in the prior presentation from Microsoft, and a new one, also a 29 strike in a ETF called QID that I showed in the prior presentation has a large volatility number associated with its ask quote. QID is an ultra-short QQQ, a so-called inverse ETF. The call option makes money if you're bullish on Microsoft. The QID inverse ETF makes money if you are bearish on tech stocks. So it's sort of an inverse to the tech stocks, which include a basket of tech stocks shown there. We can compute past volatilities by simply looking at the rate of change that have actually happened, computing their volatility number, and then charting that number. You have to pick a time period to find your rate of changes, and we're going to use 90 days. So each dot that you see in the black line is we took the last 90 days of price differences and computed the volatility in the differences in those 90 days. That number is called the statistical volatility, also sometimes called the historical volatility. We see that Microsoft had some fairly large differences where this blue arrow is shown right here. These large differences entered into our computation and increased the value of our statistical volatility, the so-called SV. Here's the SV scale on the right-hand side. Here's the stock scale on the left-hand side. After these large numbers and differences happened after this earnings date, we ended up with a number of small values, little bitty differences that occurred on day-to-day. Those small differences accumulated, and eventually it turned the statistical volatility curve around, and the statistical volatility curve came back down to very low values, down into the 20s at the end of this chart. And that's exactly how volatility moves up and down. Here's QID. This is the stock chart for QID. QID ended at the end of this time period at around 29.1, approximately the same value as Microsoft. But during the time period, its statistical volatility numbers, computed over the same period of days, are much larger. Here's the scale on this side, and this scale goes into the 30s and upper 30s. During this time period, there were large differences within the QID close price that resulted in large statistical volatilities, and then the volatilities and the change in prices became small numbers, but this drove the statistical volatility down to its low values, which occurred towards the end of this chart. But overall, QID volatility inside of its actual close prices was significantly larger statistically using real data than Microsoft. What about future volatility? Future volatility is where we expect the volatility of the stock to be into future, where we think its dispersion might be as time goes forward. When you pick a number, you can compute the dispersion of the future stock. This dispersion computation is called a cone chart. These are some cone charts shown here on the right-hand side. These are 60-day cone charts. They start at close of QID on October 12th and go into the future by 60 days. I use the number 31.8% volatility to compute this particular cone chart. One standard deviation, this is where we expect 68% of the stock to be in that time period. Two standard deviations, we expect the stock to be contained inside that cone 95% of the time after 60 days have gone by. If we increase what we think the future volatility will be from 31.8% to 45.3%, we see that the future cone areas increase significantly. So an increase in what we think the future volatility will be causes an increase in the dispersion that we'll think might happen in the stock as time goes by. A stock with a high implied volatility has an expected larger dispersion inside its cone chart. Here's the prior cone chart. Here's the new cone chart. This is an increase just from 31 to 45. We see that the area increases quite significantly when we change from just 10% in the implied volatility. A bunch of math guys in the 70s were puzzled over the pricing of options and their relationship to volatility. Everybody knew there was a relationship, but what was it exactly? They figured out a derivation. It became known as the Black-Scholes formula. It's been modified to have the American style options, which can expire at any time, but we still call it the Black-Scholes formula. Using the Black-Scholes formula and its assumptions about Gaussian statistics, the option type, the dividend rate, and the interest rate that are occurring now, we can plug into it the current option price, the current stock price, how many days are left to expire, what our strike price is. And this formula will compute what these numbers are implying about the future volatility caused by that option quote, giving us an actual number, the implied volatility. The higher the implied volatility, the larger the option quote, and vice versa. Now, the really interesting thing about this Nobel Prize winning Black-Scholes formula is that it has to balance. That means that you can use it in a different way. If instead of feeding it the option quote, you instead feed it the implied volatility, and you try different stock prices, different expirations, and so forth, this formula will tell you what it predicts the option quote should be. So it's an option quote prediction model. It will tell you option quotes for situations that have not happened yet. As long as you think that this will be the volatility everybody is thinking will be in the future, we can predict option quotes. We can decide what will be profit and losses in the future. Now, the future volatility is really unknown. So in order to use this, we have to have some assumption about what future volatility is. And in options analysis, it's basically a constant assumption using the latest quotes inspired implied volatility. We do have the ability for you to change that assumption, but that will not be shown in this presentation. Using the Nobel Prize winning formula, we have inside of optionsanalysis.com a call option calculator. The call option calculator allows you to input various assumptions about the option on the left-hand side, stock, strike, and implied volatility numbers, and how many days are left. Hit this calculate button, and it will show you price of the call option, as well as some other variables we will want to discuss in this presentation, which are called the Greeks, delta, gamma, and theta. This is the Microsoft 29 strike call option at a 29.2 stock price. If we input 0.84 for the price, the volatility that this model pumps out is 21.40. If we hold 21.40 constant and increase the stock price and leave the days to expiration still to be 35. So in other words, we're trying to discover if the stock would suddenly change, where might the option price go? So with the value of 30 for the stock price, we click calculate. We end up with a call option price of 1.336. This is a prediction of where we think the call option will go based on the Black-Scholes formula, assuming implied volatility is going to change. Well, using that formula, we can draw something called today's Microsoft call option risk chart. It's shown here on the right-hand side. It's this red curve. Now, we already have computed 2 points. We know that when we buy the call option today at the close of 29.20, our profits will sit at 0. We haven't made any money yet. The stock hasn't changed. So that's 1 point. We computed another point. We moved the stock to 30. And we asked, what was the price at 30? And we got the number 1.34, shown right here. Well, we paid 85 for the option, so our profits are 0.49. Multiply by our 100 multiplier to get it converted to dollars. We see that if the stock were to suddenly jump to 30 with 35 days to go, we would be sitting on a profit predicted of $49. And that's exactly the point that's shown right here on the red curve when the red curve intersects 31. We get a profit of $49. So we can take the Black-Scholes formula, we can move the stock price from 25 to 32, compute our profit with a fixed ID, and find all the points that form this red curve, stock goes up and no time has gone by, just like in a stock chart, and we participate in losses. The profits increase as the stock goes up, and the losses occur but then start to decrease and eventually become finite as the stock goes down. The value between the red curve and the black expiration line is what's called our profit loss area, and it's time dependent. As time goes by, that red curve is going to start to move. It has to start moving and reach the expiration line when we get to 0 days. Here is the QID, call option risk chart. In this case, I've drawn all 4 risk lines that are available inside optionsanalysis.com. There's the red curve line, which we just saw from Microsoft. There's the black expiration curve line, which is for QID. It has larger losses. And as you see here, the red curve line, for the same scale on the stock price chart, takes longer to reach the black curve both at the top and bottom. That's because there's more implied volatility inside the QID call option close. The blue line is what happens to this risk chart line as time goes by. Specifically, we move 1/3 into the future between where we are now and what happened in the risk timeline. The green curve is 2/3 into the future. You see, here's how our profit risk is going to change as both the stock moves up and down and as time changes. This curve between the red line and the black line is a much larger area for both losses and for time value deterioration. Higher IVs mean more expensive call quotes, more loss regions, and higher break-evens. Here's the option chain from Microsoft for November. I am focusing on the IV column and the delta column. The IV column is the implied volatility from the quotes that you see under the bid and the ask. We see that the quotes that are at the money have a lower implied volatility than quotes that are out of the money. The implied volatility is a really nice number. We can compare different strikes with each other. We can compare different options for the same stock but at different times. Which one is more expensive than the other? The one that's more expensive has a higher implied volatility. We can compare the quotes of 2 different stocks. The one that has the higher implied volatility is more expensive. Implied volatility is a convenient measure to compare different things to see which one's cheaper and which one's more expensive. Delta is a Greek. We'll be getting into the Greeks in just a second. The option chain is showing the Greek values of these particular call option bills quotes. If you take the IVs for the Microsoft quotes and put them on a chart, you will get what's called a call option IV skew chart. The bottom scale is strikes. The vertical scale is implied volatility. You see that the skew chart has a smile associated with it. Implied volatility at strikes different from the at the money strikes, the one near where the stock closes, are much higher. Why is that? Skews became more prevalent in options trading after a crash that happened in the 80s. The Gaussian assumption is pretty good on a day-to-day basis, but every once in a while you get events that are just not predicted by the Gaussian distribution, sometimes called black swan events. We get stock price changes that really were never supposed to happen in your lifetime, but we've had more than one of these happen in our lifetime,
options want more money to trade these out-of-the-money call options. Get more money, they raise the quotes to get when the quotes get risen, that increases the implied volatility and causes the smile. Almost every option chain that you look at has a smile to it of some kind. The bid and ask each have their own ID value. This chart was computing using the mid-quote assumption. close. This will result in greater profits, and you can actually see what profit change will be using this chart as it works to indicate to you what is your sensitivity to changes in your volatility. A straight call option at expiration has no sensitivity to implied volatility. This shown right here shows that as we get to expiration, the sensitivity to the implied volatility simply just goes away. And as we approach expiration, it's less and less. Not all multi-leg option trade positions have this property. Some is very sensitive to implied volatility, even at expiration of these options. You have to pay attention to the implied volatility curve on the risk graph if you have a volatility sensitive position. After I've shown you around the whipsaw, I have to finally put up an example. Microsoft April 2012 put-in call option as it's shown inside the options analysis category. Risk graph page. There are, top of the risk chart, three boxes. That box shows your stock, your sector, your dividend, and your statistical volatility. So your base is a stock that's looking at its average in the stock. Right side shows profits and your Greeks for 3 quotes at each chart. Asset side of the bid with the profit side of the average value. Optimistic is there to show you an extreme case on the other side that you get to sell at the asking value, just to give you a range of values. Down here is your position, which is one leg of your October 12th, one contract. This is your option symbol. 12 expire, 20-day call option. You pay 0.85 I'm showing you the line 6 days after the pre-fund. 6 days after the pre-fund, there's a bid ask of 7.18. The option was making money. In fact, I was making $13. This is $13 showing the profit. This is closing it during quote sections. For some other stocks and other options, the profits don't show exceptions can vary widely on Microsoft in terms of this experience. This is the rate of return of that $13. This is the IV of the current close. If you click the IV, you see that will take you to the option category. That's a nice way to get there. This is the volume of open interest that's happened. 3 days left. This is your latest delta gap. You see that we started with a delta of 50, because the stock hasn't moved up, delta hasn't moved up. Now we're closer to the 60% delta gap. QID